Hello, this is Michael Moriarty, Chief Investment Officer at Wellspire Advisors. This is our biannual market recap and look forward call. Thank you for joining. I'm joined today by my colleague, Dimitri Katz-Nelson, Deputy CIO here at Wellspire Advisors. Dimitri, it feels like the word unprecedented we've used to describe the years in review, a number of years recently. And once again, I think 2022, we can absolutely use the word unprecedented. Why don't you fill us in?
Yeah, we seem to be swimming in a hyperbole these days, unfortunately. But the unprecedented is it was the worst bond year in close to 100 years, and frankly, it's just as far back as we have data. So we were investment grade taxable bonds in the U.S. were down 13% in 2022. The worst year prior to that, they were down less than 3%. So that on its own is unprecedented. Stocks were also off a fair bit, but it was the seventh worst year for stocks, off 18%, and folks have become somewhat used to that. But if you put them together, obviously thinking about a balanced portfolio, really across any risk spectrum, it was a double-digit loss year and definitely unprecedented over the last 100 years for U.S. investors.
And for those clients listening in that have long memories and are thinking about the 1970s and 1980s, you might rightly think, well, wait a second. I thought yields, interest rates went up a lot more in the 70s and 80s. I remember all this talk about Paul Volcker. You're right. Rates actually did move up greater in some periods during the 70s and 80s. And why aren't we talking about bond market returns in those years as being worse in 2022? The big difference is that while rates were rising more back in the 70s and 80s, you were starting from a much higher absolute yield than we were in 2022, i.e. yes, yields in the 70s and 80s went from 8% to 12%, but you were still earning 8% on your core of your portfolio. And that offset a lot, and in many cases more than offset the decline in your fixed income portfolio because of rates. In contrast, beginning 2022, the yield was only 1.75% for the most commonly quoted index, and so much less cushion to offset what ended up being a significant rise in rates. Dimitri, we often talk about looking at the past and also now looking at the current state of play. Certainly, there are headlines galore around the debt limit, the ceiling, and the political rancor that's going to come along with that. Any comments on that, or other things that are either in the headlines or used to be in the headlines but are still happening?
Sure, we're the Fed and inflation have taken a backseat to the debt ceiling these days, so we'll touch on that. Obviously, you're all reading the headlines. This is not the first time we've come across this. The Treasury, federal government has had to raise the debt ceiling over 100 times in the last 80 years. We come across these acrimonious periods back in 2021, 2019, and all the way back. It always seems more scary the latest time around just because it's more recent, but there are obviously avenues for the Treasury to keep paying off its liabilities up until through the summer, even in the fall, before it gets bad. But it's happened many times. So I think what we're looking at right now is just how much flexibility the Treasury has. Tax season is coming. They're going to get a little bit of influx of cash here, so nothing immediate. And we do ultimately think there's a very, very low probability event of anything truly terrible happening, as we've seen in past examples. Things that maybe fallen off the headlines, but I think still relevant. The Russia-Ukraine story is still there. It's still happening. It's fallen off a bit because Europe was able to generate and store enough natural gas for this winter season and benefit from warm weather that it hasn't become, you haven't seen stories about people freezing there, but that is still something that hasn't gone away and something that we're keeping an eye on.
China reopening is obviously going to impact markets. Thinking ahead and how we're thinking about portfolios, I think you and I and the investment team and more broadly, and I think investment folks generally are not giddy people. We tend to not get excited about a lot of things. If forced, I think we would say we're marginally excited about fixed income, as we've discussed a lot on this call. I think core high quality investment grade yields are 4%, 5%. Those are levels that you haven't seen in many years. And take an iota more credit risk, and you can get 6-7% returns. Those are levels that we were expecting in total returns in the equity markets as recently as a year ago. Speaking of equities, I know Dimitri, you have some thoughts on valuations. Want to share those with us?
Sure. Short answer is better, not great. 2022 actually we had positive earnings growth, which is good, and markets were down, which means what you had was valuations become more compelling. So they definitely improved. They haven't been as good in a while, but they're not historically cheap. They're not historically low. So whether we look at U.S. markets across large, mid, small, we look at overseas, things have definitely improved, and that does translate to higher expectations going forward. But this is not a back up the truck situation as we've seen in prior crises and prior sell-offs.
Dimitri, we just touched on fixed income yields. We talked on equity valuations. There's always things that we're looking ahead to, some good, some bad. Why don't you rattle off a couple that we're thinking about?
The big story remains the Fed and inflation. It's the question we get asked the most about over the past year. And the question is, when does the Fed stop? The answer is fairly straightforward, though no guarantees, is that the Fed should stop when the Fed funds rate is north of inflation. Right now, inflation is still running at 6.5%, but as we look at over the next couple of months of adjusting base rates, is we should get sub 5 over the next 2 quarters. By that point, the Fed should be right around there. So the Fed should stop over here in the next couple of quarters. So that's one positive dynamic. On the flip side, there's obviously economic slowdowns in play.
Yeah, that's right. And I think that's, as it typically is, you can look at data to support whether there's going to be a recession at all, yes or no, or if a recession, whether it's going to be a hard landing or a soft landing. I think that, to me, the data is increasingly saying it's probably not going to be a hard landing. A lot of areas of the economy are pretty robust. And also, too, as we often remind people, the market is not the economy. And those behave on their own schedules and often very differently. And we typically see markets bottoming well ahead of the economy. And so even if we do have a recession in Q2 or Q3, it would not be it would not violate historical norms for the fact that the markets have already 6 months ahead of time already bottomed and starting to see the other side of that. Well, thank you, Dimitri. That was a lot to cover. We could have gone on and on. We tend to always have a lot to cover. That's the nature of the financial markets. But thank you for listening. As always, if you have any questions, please reach out to your advisor team. We're always happy to jump in where you have questions or where you need some additional thoughts. So again, thank you for listening. This has been the biannual WealthSpire Market Recap Call.